we can commence from where we stopped. I want to talk about a few things on limited company, a few things basically on the limited company. We stopped at when you talked about methods. We talked about methods of determining, just a recap of determining what's called the taxable income. Taxable income, we say, of what we call a limited company. Taxable income of what you call a limited company. I hope I'm writing in a big way. I need to write in a big way. So basically say that the two methods, we talked about the gross profit method. So for the gross profit method, we basically say, 𝐻𝐻, are you able to see the handwriting clearly? 𝐻𝐻, are you able to see the handwriting clearly? Are you able to see the handwriting clearly? The gross profit method, that is when we are not given the accounting profit. So then we have the second method. We talked about what's called the net profit method, what we call the net profit method. And for the net profit method, we apply when we've been given the accounting profit. So we say that for limited company, we say that we tax resident, what we call the resident company, at 30%, at corporate rate of 30%, and the non-resident, 37.5%. For the non-resident, 37.5%. So I want you to include a number of things on this. That is what you talk about company located, companies, we say located at 𝐼𝐍, Remember this concept of 𝐼𝐍, we're also going to touch this concept under what's called the tax planning. For companies that are located at 𝐼𝐍, that is the export processing zone, they now have what you call favorable terms of tax. What are these favorable terms of tax that companies that are located at 𝐼𝐍 enjoy? What are these favorable terms of tax? Do they basically enjoy? Companies that are located at 𝐼𝐍, what are these favorable terms of tax that they do enjoy? Some of the things that they enjoy, we know that the tax holiday, we say for what we call the first 10 years, tax holiday, that's basically we call it for the first 10 years, tax holiday for the first 10 years. And I've said that this concept of 𝐼𝐍, again, you're going to tackle it under what you call the tax planning. What are tax planning opportunities that are available for a limited company? And you talk about for a lower tax rate, what we call a lower tax rate from, we say, of a lower tax rate, we say of 25% from what we call the 11th year. And no writing notes in the class. I hope you have the notes. No writing notes together. So then we also need to understand that dividends paid to non-resident. We know that dividends paid to the non-resident, dividends paid to the non-resident is usually exempted from tax. Dividends paid to the non-resident, we say, is usually exempted from tax. Then I want you to do something, additional, what we call additional allowable expenses, what we call additional allowable expenses for the limited companies. What are the additional allowable expenses for the limited company? What are the additional allowable expenses? So we have additional because companies now have directors. We say that directors fee, stock remuneration, directors fee, stock remuneration. Those are what you call additional. Are we together? Fee, stock commission. These are basically related only to the companies. But you also talk about what you call the cost of issuing shares. Now, cost of what you call issuing of shares. Cost of issuing shares, and we basically call it the flotation cost. Together, team. These are additional allowable expense. These are unique to the limited company. Together, we respond with a yes if we are together. We respond with a yes. Then I want to talk about additional. What do you call additional? We call it additional non-allowable expenses. Additional non-allowable expenses. What are the additional non-allowable expenses for the company? Additional non-allowable expenses. When you talk about additional non-allowable expenses, we talk about any form of dividends. Any form of dividends. It can be interim, final, are we together? Interim, proposed, in taxation, any form of dividends is non-allowable expense together. Then you have what you call reserves. What you call the reserves. So when you're dealing with a limited company, you need to note this. Together, team. Are we together? We respond with a yes if we're together. Perfect. Then I want to talk about installment tax. What we call the installment tax. When you look at those previous level, you are not touching on the installment tax. Installment tax. What we call the installment tax. Number one, I want to ask, is installment tax an additional tax? Is it an additional tax? Installment tax is basically not what we call an additional tax, but basically a way that limited company can pay the end year tax before the end of the year. So we say that it is not, we say an additional, we call it an additional tax. It is basically what we call not an additional tax, but a way, we say a limited company, pay its corporate tax, pays its corporate, pays corporate tax, a way that limited company pays corporate tax during the current year. During what's called the current, a way it pays corporate tax during the current year. The way limited company basically pay their corporate tax during the year. Then before the end of the year, you pay it way in advance in the current year in installment, in what you call installment. A way that limited companies basically pay their a way that they pay their corporate tax, current corporate tax, before the end of the year. Perfect. So how do we go about it? How do you basically? Do they consider time value for money? Very interesting. Do they consider time value for money? So very interesting. We'll talk about that. But how do they go about it? Because it's being determined during the current year before determination of the actual tax. When are we supposed to determine the actual tax? For example, if you had a limited company, So because it's determined before the end of the year, it is based on what we call estimation. It is basically based on estimation. So it is basically based on what we call estimation, Robert, altogether. It is based on estimation, which is done at the start of the year. Estimation, we say done, we say at the start of the year, at the start of the year. Done basically at the start of the year. Because for this, it is paid for the current year, we do it on estimation, and that estimation is basically done at the start of the year. How do we estimate? How do we estimate? We basically estimate by saying that for the following year, it is estimated that is going to be 110% of what we call the previous tax. If the previous taxable income was 100,000, what would you expect for the current year if the previous was 100,000? What is for the current year? We say that estimation is basically done at 110 of the previous tax for a previous tax for a continuing, what we call for a continuing company, for a continuing company. So if the taxable income was basically 100,000, what would be the tax for the current? If it's done, the previous was 110, was 100,000. So that should be 110K, 100K. So we have two concepts. We have what we call the non-agricultural, for the non-agricultural companies, for what we call the non-agricultural companies. For the non-agricultural companies, we basically know that we have 4 installments. For the non-agricultural, if it was estimated 110, so that tax that needs to be paid, it needs to be paid in 4 installments. So we have on this, we have what we call installment. We have what we call amount of the installment, amount of what we call the installment, amount of the installment, amount of the installment, and then you talk about the due date. So when should the first installment be paid for the non-agricultural companies? When should be? In most cases, that will not, because they do not have a previous altogether. Because they do not, most of them would not pay that altogether. Most of them would not do that because they do not have a previous tax altogether. Most of them, Kennedy, would not pay that altogether in majority of time because they do not have what to estimate. So the first installment, we basically said on the first installment, when you talk about the first installment, it's being paid. This was done even on the PFT, but we do not, we say 25%, we call it 25% of total installment, 25% of the total installment, and say we pay it by 20th. By 20th, we say of the fourth month, we say in the year of income, in the 4th month of the year of income, by 20th of the 4th month in the year of income. Then the second installment, when you talk about the second installment, we have what we call the 25% of what we call of the total installment. And now that we pay 20th of the 6th month, 20th of what we call of the 6th month, we say in what we call in the year of what we call in the year of income. 20th of the 6th month, basically in the year of income. Then we have what we call the third installment. When do you pay the third installment? When do you pay? Again, this was 25% of the total installment, 25% of what we call of the total installment. When do we pay it? When is it being paid? We also know that 20th of the 9th month, 20th of what we call the 9th month, 20th of what we call of the 9th month in the year of income, in the year of income. 20th of the 9th month in the year of income. 20th of the 9th month in the year of income. Then lastly, the fourth installment. Fourth installment. So fourth installment, again, we know that that's 25% of what we call of the total. We call it of the total installment. 25% of the total installment, and that is 20th of the 12th month. We have it as the 20th of what we call the 12th month, 20th of the 12th month. We say in what we call the year, in the year of income. Together. Those are the four installments. Then at the end of the year, what happens? What happens? At the end of the year, what happens? At the end, we have what we call the final tax. Final tax. Final tax. We say based on actual tax. So at the end of the year, you're able to calculate the actual tax, where we're saying that actual tax minus total installment, actual tax, we say minus what we call the total installment tax paid. You get the actual tax, then you less minus the total. Sheila says, let me see. On second installment, is it there? 25% of the total installment, we pay it on 20th. You see, if the total installment, you divide it into 4, are we together? So equally. Remember, these figures are equal. Sheila, these figures are equal. Sheila, I'm saying the figures are equal. Basically, those 4 installments should be equal. That's why you say of the total. So the final, what we call the final tax based on actual. So we call it actual tax paid minus what we call the total installment paid during the year. When should this be submitted? When should this basically be submitted? That should be submitted by what's called, we say by the 30th of what we call the 4th month, by the 30th of the 4th month after the year of income. We say after what we call the year of income. After the year of income. Together, team. After the year income. If you're together, we respond with a yes. We respond with a yes if you're together. I will talk about that when you pick a question. Yes, we will talk about that when you pick a question. There's a very good question that I will talk about, penalty that emanate from that candidate. Yes, I will talk about that when we do a very current question that is August 2024. Yes, are we together? We will talk about that. Why not 30? Those are law. That is how. Why not 30th June? That is a law. You see, those are tax laws. So then, when we go to agricultural, we go to what we call agricultural. Agriculturals are basically agriculture. We say, when you talk about the agriculture, we talk about agricultural, what we call agricultural, what we call the agricultural companies. Agricultural companies. So for agricultural companies, basically, if we have that, we have that is B. We have installment. We have installment. We have what we call amount, or what we call of installment paid. Then we have the due date, what you call the due dates. So for the agricultural, we know that the first installment, but basically two, first installment, what you call the first installment. For the agricultural, the first installment, we say that 75%, we have a 75% of what you call the total installment. 75% of the total installment. And the due date should be 20th, we call it 20th. We have it 20th of the 9th month in the year of income, in the year of income. Basically in the year of income. Basically in the year of income. Then you have the second installment. The second installment. So we have the second installment, that is 25% of what you call of the total installment. 5% of the total installment that we pay 20th of the 12th. We say by 20th of what we call the 12th month of the 12th month in the year of income, in the year of income, in the year of income, in the year of income. Then we have the final tax. Final tax based on what we call on the actual tax. Final tax based on what we call the actual tax. We say actual tax at the end of the year. We have the actual tax at the end of the year, final tax at the end of the year, minus what we call the total installment, we say paid during the year. Total installment paid during the year. Then you have what's called by 30th. We can talk about by 30th. By 30th, we say of the 4th month, by 30th of the 4th month, after the year, we call it after the year of what we call the income. After the year of income. By 30th of the 4th month after the year of income. Together. I want you to note those ones somewhere. Together. So particularly this question, the most recent question basically touched on what we call banking. A very recent question that was August 2024. August 2024 on the banking, taxation of banking. Are we together? So when I begin on banking, I will touch that banking question and attach on the installment tax together, team. The other question was basically around 2017. The other question was basically around 2017. But a very present question on the installment tax basically touched on August 2024 together. So as we introduce the bank, I think that will be the first specialized. We will also tie it to the installment tax. And I will talk about penalties that would emanate from that. We respond with yes. I want to talk about taxations of related company, taxation of groups, related companies, and head office and branch. So taxation, then we pick on questions now. Taxation. We have what's called taxation. We have what's called taxation of group. What we call taxation of what we call group. Taxation of group. We say related companies to related companies. Taxation of groups, related companies. And say an head say head office, and what call end branch. Head office and the branch. So a company is basically considered a group of company if they're related. Companies considered, say considered a group of companies, a group of the companies of company, considered a group of companies. Companies, we say if related. How do we manifest relationship? How do relationship? Companies are related in the following ways. Related in the following ways. How do we have relationships for companies? How do we relate the companies? Companies, how are the companies related? We have parent, what we call the parent, and subsidiary relationship. Parent and what's called the subsidiary relationship. How does that relationship work when we talk parent and subsidiary? So this is where we know that the company acquires, in this acquire, more than 50% of what we call the share capital of another company. A company acquiring more than 50% of the share capital of another company. That is parent and subsidiary relationship. So when you see, for example, a company basically acquires 70%, then that is what we call parent and subsidiary. Then you have the second relation, we call it joint venture, what we call a joint venture relationship. What is a joint venture relationship? When you talk about a joint venture relationship, what does it mean? What does it mean? A joint venture relationship. 50-50, that is definitely 50-50. So a company basically acquires 50% of shareholding of that other company. 50% shareholding, 50% shareholding in that other company. Then you have what you call the venture associate. What you call the venture associate relationship. So when you talk about venture associate relationship, venture associate, we've said 50-50 T. We've said 50-50 T, kindly. T, 50-50. 50-50 relationship. What is a joint venture? Venture associate relationship. So when you talk about venture associate relationship, a company basically, a company basically acquires more than 20, but not more than 50. Robert has it. More than 20, but not less than 50, and more than 20. We say that a company, we say acquires less than what we call less than 50%, less than what we call 50% shareholding in that other company, a company acquires less than 50% shareholding in that other company, and more than, and you say in more than equivalent, more than equivalent of what we call 20% of the shareholding. Tuko sawa? Kila mtu ameelewa hapa? Together. Then the NP, this is now very important in taxation. When you see the questions, that is the main point. I want you to notice this. So in taxation, when you talk about a subsidiary and the parent company, we tax them separately or together. When you talk about this joint venture, we tax them separately or together. We basically tax them separately together. Are we together? We tax them separately. A parent company and a subsidiary, basically we tax them separately together. So in taxation, if you see a subsidiary and a parent company, that is a good point. If those questions come, you need to know that a parent and a subsidiary we tax separately. When you talk about associates, what they call venture associate relationship, we also tax them separately, and also the joint venture. So in taxation, we know that in taxation, we know that relationships are not considered. So basically in taxation, we know that relationships are not considered. And we basically say that each company, we understand that each company is taxed. We say that is taxed basically independently. Each company is taxed independently and separately. And you say, and separately, we say that without considering. We say that without considering that there are what we call the share acquisition. There are what calls share acquisition. There are share acquisition among them. Together, without considering that there is what we call the share acquisition amongst them together. So when you see that in tax, you simply create a parent and a subsidiary. You don't combine them, but you have the parent company and you have the subsidiary together. We respond to this. And the last thing, then we pick a question together. Then I want to talk about what we call the head office and the branch. What we call head office and branch. Head office and branch. How do you tax head office and the branch? How do you basically tax head office and the branch? Head office and the branch. So when you talk about head office and the branch, they're not taxed separately altogether, but they're taxed, they're not taxed independently, but they're combined and taxed together. When you talk about head office, when you see head office in the branch, they're basically not taxed independently, but combine their income together. And we combine their allowable expense and we tax them together. That is for the head office and the branch. Is that noted? Head office and the branch, we basically tax them combined together. So we know that they're not considered. We know that they are not considered to be separate. They're not considered to be separate. We know that they're not considered to separate entities, and say, and therefore, not taxed. We know that not taxed separately. So they're not considered to be separate entity, and therefore they're not taxed separately. We know that they're combined. They are combined. They are combined together. We know that they are combined together as one company. We know that as one company under which they operate, as one company under which we say they operate, under which they operate. So that is done. Is everybody okay? I want us to pick our first question. I want to pick a question that basically touches on this concept on related company, branch and subsidiary, and takes also the concept of head office. So that is December. There's a question in December 2024, a very good question that combines that. December 2024. Look at December 2024. That should be about question 2. Send the paper, somebody to forward the paper. December 2024. December 2024. Forward the paper, Sheila. December 2024 paper. December 2024 paper. Sheila, forward the paper. Deck 2024. Question. For the papers, we have it in the group. Sheila, forward the paper. Perfect. So that's question 2B. Question 2B. Question 2B. Are we on it? If you're on it, we respond with this. So done. Thank you, Sheila. Are we ready? Can we start working on that particular question? Can we start working on that particular question? So perfect, you can start. So we've been told that 𝐼𝐍𝐼 Limited, we're told, is a holding company. 𝐼𝐍𝐼 Limited is a holding company operating through 2 independent branches. The head office and worker branch located in a different town. So being told that 𝐼𝐍𝐼 Limited is holding companies, is all operating through 2 independent branches, the head office branch and what we call the worker branch, located in different towns. So we've been told that the company acquired 100% of Zuri Limited in the year 2022. Then you're being told that the following information has been provided to assist in determination of what we call the taxable income. So when you look at that, we have the sales, we have worker and head office and worker branch. In relation to that, what happens to Robert when you have that? Worker and the head office. In relation to taxation, how should we tax them? Worker and the head office. Those should be combined together. What do you say? When you're taxing, we should combine the worker and the head office. What about the Zuri, which the company acquired 100% of it? What about the Zuri? The Zuri should be taxed independently or separately. So we look at that. We have the sales. We have what we call the cost of sales. We have what we call the cost of sales. And then we have the gross profit. We understand that gross profit is what? Gross profit, is it a taxable income or a non-taxable income? The gross profit, is it a taxable income or a non-taxable income? Gross profit, is it a taxable income or a non-taxable income. That should be a taxable income altogether. But remember that gross profit, that is what you have. Then you have other incomes. Number one is profit from the sale of security. Is that a taxable income or a non-taxable income? Profit from the sale of security. From sale of security. Profit from the sale of security. Is that a taxable income? Profit from sale of securities. Somebody else. Profit from the sales of securities. Is that a taxable income? That should be non-taxable. Sheila, Robert, and securities of capital, those should be non-taxable together. That should be a non-taxable income. We respond to yes. Perfect. So then we move to the next what we call dividends from 𝐻𝐶 cooperative. Dividends from 𝐻𝐶 cooperative. When you receive dividends from cooperative society, that is a non-taxable income. Are we together? Number one, a dividend is an investment income. Together, team, I'm explaining something. Dividend is an investment income. However, it is an investment income that is subjected to further taxation. It is an investment income that will basically subject to further taxation. To Melawana. So we are going to less it, but we are still going to add it on other income. The essence of lessing it on, are we together as we're adjusting, is to get what we call the business income. Many pattern. So I'm saying that dividends from 𝐻𝐶 cooperative, we say that is an investment income. It's not a business income. So you'll find as a tax person, you less it. Why do we less it? To get what we call the adjusted business income. However, you're going to add it again at gross on other income. On other incomes. And Tukosawa. Perfect share. So then we have what we call interest from bank. When a limited company received interest from bank, that dividends is non-qualifying dividends. When a limited company basically received interest from the bank, how do we treat it? When a limited company received interest from the bank, how do we basically treat it? How would we treat it? When a limited company basically receives interest from a bank, how would we basically treat it? Yes, that's a non-qualifying. Robert will say that it's non-qualifying. The first concept that I want you to understand is that non-qualifying. Tuko pamoja. That is non-qualifying. When a limited company, we did an investment income. When a limited company receives interest from a bank, that is non-qualifying interest, meaning the 15% withholding tax is not final. But number one, you need to understand that interest from the bank in relation to a business, are we together? In relation to a business, interest from a bank in relation to a business is what? Is a non-taxable income. However, because it's a non-qualifying interest, we are going to less it, but still add it on other income. If it was included in the business income, we definitely need to less it in order to get what we call the business income, together. So we proceed to the next. I hope you've understood. We go to expenses. We have total incomes now. We go to what we call the expenses altogether. So repairs and maintenance. Is that allowable expense or non-allowable expense? Repairs and maintenance. Is that allowable or non-allowable? That should be allowable expense. The same concept for those who typed on intermediate. Some things are just the same. Are you seeing that, Robert Uko? Some concepts are the same. And that's why I say, as you go ahead, you realize that even on these particular questions, and Celestine, I need to know everybody, Chengo, and the rest of the class. I need you to understand that at the end of the day, this particular question, there should be no students, even if you don't understand many things, there should be no student who scores less than half. So then we have what we call the finance charge. How do you treat finance Is it allowable or non-allowable? The finance charges. That should be allowable. Then you have the legal fee. How do you treat legal fee? Legal fee, it depends. However, it depends. Realize that when you talk about the legal fee, there is what you call legal fee that is allowable, and there's legal fee that is non-allowable. Together, tuko pamoja. Yes, more than 99 is non-allowable. Less than 99, leasing together. We know that for leasing, renewal of a lease, are we together, or renewal of a lease that is more than 99 years should be non-allowable. But if it's less than 99, then that should be allowable. However, we are saying that when you look at legal, there's a concept that I taught. If you look at those lessons altogether, legal fees that are allowable and legal fees that are non-allowable. Is it in those videos? Is it there in the videos? Yes. So you need to get that. However, if you're provided with the legal fees, and there's no additional information, how do you treat it? If you've been provided with the legal fee and there's not additional information, how do you treat it? We treat it as allowable. So what's our? We treat it as allowable. If we have a legal cost, a legal fee, and there's no additional information, we basically treat it as allowable. So that should be the norm. So this legal fee, it depends. Then we have what you call depreciation. How do you treat depreciation? Depreciation is non-allowable. Outrightly, we do not have an expense called depreciation in taxation. Then you have what you call computer software. How do you treat computer software? Computer software that is non-allowable. Then you have what you call the lorry scrapped. Lorry scrapped. How do you treat the lorry scrapped? Lorry scrapped. Lorry scrapped. Lorry scrapped. That's non-allowable because lorry is what? Is the capital expenditure. So expenses that relate to capital expenditure, those should be non-allowable. Then you have the next what you call the loss on investment. Loss on investment. What do you call loss on investment? Loss on investment, that should be non-allowable. Thank you, Chengo. That should be non-allowable. Then you have the next what we call the traveling cost. How do you treat the traveling cost? Traveling cost. Next is the traveling cost. So traveling cost is allowable. Then you proceed to what we call staff pension contribution. Staff pension contribution. Staff pension contribution. Staff pension contribution. How do you treat the staff pension contribution? How do we treat what you call the staff pension contribution? That should be allowable. Then you have what you call intangible assets. What you call the intangible assets written off. Yes, that should be non-allowable. If it was private, it's non-allowable. So that is instance where we have additional information that says it's private, then that should be non-allowable. So on instance where you have an additional information, then it says that that was a private expense, and then that should be non-allowable. Then we have what you call intangible assets written off. Intangible assets written off. How do you treat the intangible assets that are written off? Intangible assets that are written off, that should be non-allowable expense. Then you have the next what we call director's allowances. Director's allowances, that should be allowable expense. Then you proceed to what we call investor's loss. Investor's loss. Investor's loss. Investors' loss. Investors' loss. Investors' loss. Investors' loss. Is it inventory subject to? This particular question, that should be an inventory loss. That should basically be inventory law, inventory loss. We'll check on that, but it should be something on inventory. Based on marking on that, I think that should be about inventory law, inventory loss, but we check it. Oh, is that okay? We check it on the additional information, together. Perfect. Then we have the next staff salaries. Staff salaries. So staff salaries that should be allowable. Then down there we have total expense. Then we have what's called the net income or the net profit. That is for the head office, for the branch, head office branch. We have the worker branch, and then we have for Zuri Limited. Remember the head office branch and the worker. Rent and rates should be allowable. Rent and rates should be allowable. What you call rent and rates should be allowable. Tuko pamoja. That should be allowed. Together. That should be rent and rates. Sorry. That should be allowed. In agreement. If we are in agreement, you respond with yes. So then we proceed to the additional information. The head office branch sales include the head office branch includes goods sold to worker branch and Zuri branch, goods sold to worker branch and Zuri branch, worth 3,450,000 and 10,470,000, which were marked by 15%. Which were marked by 15%. Which were marked by 15%. Does that statement affect the adjusted taxable income? Does that statement basically affect the statement affect does that statement basically affect the taxable income? Does it affect? Does that statement affect? Does it affect the taxable income? When you're told that head office branch sales include goods sold to worker branch in Zuri, 3,450,000, that is to worker branch, and 10,450,000. It affects the gross profit. How does it affect the gross profit, Hassan Mohammed? How does it? Yes, it doesn't affect the taxable. Are we together? The GB definitely increased, but it are we together? It doesn't affect the taxable income. Yes, it doesn't affect the taxable adjustment of the taxable income. Yes, that's what happens, but it doesn't affect what we call the adjustment of the taxable income. Income are together. Are we together, Hassan? Together. It doesn't affect the adjustment of the taxable income. Taxable income. Sawa. The goods haven't been sold to outsiders. Hassan tuko pamoja. Yes, it doesn't affect what's called the adjustment of the taxable income. Income. Are we together? Most students thought that it will affect the adjustment of the taxable income. No. Together, Robert. Robert, together, we respond with a yes. Perfect. So then we proceed to the next. We're being told that legal fee for head office. Legal fee for head office. I said, for you, don't do the additional information separately. Do them on the question. Let none of my students do additional information separate. This is for learning purpose. So then we say that legal fee for head office and Zuri branch consists of 30% for 100 years lease, while the rest was a 5-year lease for head office and 15-year lease for Zuri. So the 30% 30% for head office is 100 years lease, and even Buzuri is 100 years lease. How would you treat that? How would we treat that? We add the 30% back. Why do we add it back? The 30% is non-allowable. We say that a lease that is more than a lease that is more than 100 years is non-allowable. So we look at that legal cost. So we can call it working one. Mwalimu is allowed to do that, but not the student. Don't do the working separate. I beg you as students, don't do the working separate. 𝐾𝐻, is that okay? Don't do the working separate. So we call it legal. Fee and precisely the non-allowable. So we have the head office. What is the figure for the head office to get the 30%, which is non-allowable? What is the figure for the head office? For the legal, 560. So 30% needs to be added back of 560. So give me that. Then you have the 𝐍𝐢, what you call 𝐍𝐢 Limited. 𝐍𝐢 Limited. That should be 30%. 30%. 30%. That should be 300. So get for me those figures. So get for me the 30%. Is it clear, Robert? 𝐾𝐻, is the handwriting clear? Robert and Celestine. There's some of my students that I also need to mention so that we be fair. Celestine Tukosawa, FJ Hassan Mohammed, Kennedy, Nelson Chengo, T, Sharon. I hope everything is clear. So what is 30% of this that is non-allowable? What is 30% of that? That should be non-allowable. What is the 30% that should be non-allowable? So get for me that. Mwalimu should not use this calc. Mwalimu should not let Mwalimu remove his calc. So what is the 30%? So this is 168. And 168 is non-allowable, so that needs to be added back. What about the 30%? 30% of that. Is it 90? This was 300,000, sorry. I think the 300,000, studio. You must be my supporting team. That should be 90,000. So these figures should be added back. Add back. Add back. Call it add back. Add back. So that is done for that. So then the examiner tells us that head office branch consists head office branch, head office branch, head office branch. Finance strategies consist of 10%. Consist of 10%. 10% loan of 5 million from 𝐍𝐢 advanced in January 2023. How would you treat that? From 𝐍𝐢. That's allowable. Are we together? 𝐍𝐢 and the head office, which consists of head office and worker, those are treated independently altogether. So the finance cost consists of what you call a 10%. What you call a 10%. A 10%. Finance cost, we're being told, consists of what you call a 10%. Finance charges consist of a 10%. Loan of 5 million from 5% loan of 5 million from 𝐍𝐢 Limited. Advanced in January 2023. How would you treat that? For 𝐍𝐢, it's already included in 𝐿𝐿, which is the head branch. So what about 𝐍𝐢? In 𝐍𝐢, what will you do? In 𝐍𝐢, tutaongeza kama other income, other incomes. Why do you say we less? Somebody says we less. No, Sheila, we've been told, look up, head office branch finance charges consist of interest of 10%. interest of 10%, interest of 10%. Tuko pamoja. Interest of 10%. Interest of 10% of 5 million. Look up. Interest of 10%. Head office branch charges consist of interest of 10% of 5 million. Are we together? From Zuri. Zuri gave them a loan. Are we together? It basically means that Zuri gave them a loan. Together. Are we in agreement? We respond with a yes if we're in agreement. And remember, these are independent. Remember that they're independent. So that's an expense. We are going to treat it. We are going to treat it as independent altogether. So that including it as an expense as a finance charge is okay. Is okay. Are we in agreement? We respond with a yes. Are we in agreement? When they treat it as a finance charge as an expense, that's okay. Sawa sawa Keter. Sharon, tuko sawa. Sharon, are we together? Walter, are we together? Including it as an expense is okay. However, we must remember that should be an income. Branch, no, branch are one. Branch is treated as one. Sawa sawa. So we say that for Zuri, we must remember there's an additional income. I'm saying for branch, no, those should be one. Those should be treated as one. Sawa sawa, those should be treated as one. Sawa sawa, that should be treated as one. However, we are saying, I'm saying that should be treated as one. We're saying now for the Zuri, that should be an income altogether. Because there's an interest charge, there should be an income that is added to Zuri. Interest that is from the law. Together, Robert. We respond with a yes. Sharon, if there's clarification needed, that is perfect, if we have that. That is the most important thing, explanation to this. And once we explain this, they become even much easier. Then we get to additional information. Number 4. We've been told that insurance company agreed to cover 40% of the inventory loss. So you look at the figure of 670 is not investor, but inventory loss. Are we together? The 40% is what we call the investor that should be inventory loss. Are you seeing? So working 2, the figure inventory loss, the figure of 670 is not investor, but inventory loss. Tumelewana. That figure should be what we call inventory loss. Are we seeing that? We respond with a yes if we are able to see that. Kindly we respond if you're able to see that. That is inventory loss. There's somebody who asked, I remember it, based on marking, I remember that inventory loss. So we've been told that that inventory loss of 670, insurance company agreed to cover 40%. This has not been adjusted. So compensation for the loss of stock. How do you treat compensation for the loss of stock? How do we treat compensation for the loss of stock? We know that compensation for the loss of fixed asset, is non-taxable. However, compensation for the loss of stock should be taxable. So then we get the 40%. What is the 40% for the loss of stock? Give me the 40% for the loss of stock. And we know that is taxable. We understand that should now be taxable. That should now be taxable. So that should be 268. So this 268, where does it go to? This 268, it goes to 𝐻𝐶 Limited, which is head office and worker branch. It goes to what we call 𝐻𝐶 Limited, which is a combination of what we call head office and worker branch. I hope that is sorted. So then we go to the last additional information. The examiner tells us that our head office branch staff salary consists of head office head office, head office, head office. Branch salary consists of 9,655,000 paid on behalf of Zuri, paid on behalf of Zuri, and 320 for worker branch, and 320 for worker branch. So head office or Ocean Limited pays for Zuri 9,655,000, 9,655,000, 9,655,000. This is for Zuri, what do you call the Zuri Limited? Zuri Limited. And it also pays for worker branch. Worker branch. This is the worker branch. What is the effect? This one does not have an effect. It's one and the same. Head and branch, head and branch, head and branch are one. Head office and the branch are one. Hassan asked, how do you treat the balance? The balance is not a taxable income because it's not compensated. Are we together? The balance is not a taxable income because it is not compensated. Sawa. Are we together? Because it is not compensated together. So inventory loss is allowable together. Number one, remember that inventory loss, not investor, but remember that is an inventory loss, which is allowable together. Inventory loss is allowed. Together, team, I want us to respond with a yes. Sharon, Sheila, T, Walter, Robert, and the rest of the class. Tuko pamoja. That should be okay. So then, I'm saying that if they paid an expense for worker, that does not affect. That does not affect. Are we together? That does not affect because it's one and the same. However, a payment that they make, a payment that they make to what? That they make to what? To Zuri. We are going to treat it as non-allowable. However, a payment that is basically made to Zuri, we treat it as non-allowable. Tumelewana. If they make a payment for Zuri, remember, the branch, subsidiary, and parent company are taxed independently. So if you pay for a subsidiary, a company that requires 100% of it, this is non-allowable. So this needs to be added back. We say add back to the Ocean Limited. Ocean Limited. Together, it needs to be added back. That should not be their expenses. But at the same time, take the figure of 9,655,000 on Zuri. This should be allowable. This should be allowable expense. This should be allowable expense, not included in P&L. This should be allowable expense, not included in the P&L. Understood? Is that understood? Allowable expense not included in the P&L. Is that understood? So saying that Zuri paying for Ocean, which is a branch and worker, head office and worker, paying for that expense is non-allowable. However, under Zuri, we are going to say allowable expense not included. We are going to add it back, and this we are going to do what? We are going to less in Zuri. Tuko pamoja. I want us to respond with a yes if you're together. I've arrived those. We respond with a yes. Perfect. Look up. So you see, these are independent companies. Are we together? These are independent companies. Are we together? These are independent companies. These are independent companies. So you can sell to them altogether. Kennedy, I'm saying that these are independent subsidiary, a parent company in the subsidiary, those are independent companies. So when you sell at a markup, it doesn't affect because you can sell and make a profit altogether. That is their accounts altogether. And even the subsidiary can sell to the parent company. These are independent company. Are we together? You can basically make sales to them. Are we together? You can basically make sales at a markup to such companies. That is what you're saying. Together. Together. That is, you can make sales to the subsidiary. That's why we say that's okay. Okay. We are not doing it to a company outside. These are related. These are basically related. Yes. These are related companies, not third party. So this last point, I wanted you to understand this. You see, the fact that Zuri paid, perfect. I'm saying, whatever Zuri pays for, whatever head office pays for Zuri is non-allowable because Zuri and head office are independent. Is that okay? Is this understood what I have here? So this expense that was paid is non-allowable. I want us to respond to this too, so that we close on that. Is that understood? I'm saying for worker, it doesn't affect anything because they're one and the same. But however, perfect. Can I start doing the question? Is there anybody who needs a small break, or we can do the question? Is there anybody? And if it's a break, it's only 5 minutes. We are not going to take more than 5 minutes. I want to finish 5 minutes. Is 5 minutes enough? Because I don't want to leave this class without finishing this. 5 minutes should be enough. Yes. Are we there? Are we there? Can we resume? Can we resume from where we had stopped? Perfect. We don't want to waste any time. We don't want to waste any time. So that should be okay. We just make sure we use our time perfectly well. We shouldn't waste any of our time. So then we start on that question as I open it. So being told that compute taxable profit or loss for Ocean Limited and Zuri Limited. For Ocean Limited and Zuri Limited. Which method do we apply? Which method are we going to apply in this particular question? The methods of determination of taxable income. To measure very fast. Not the gross. Robert, Walter, no. Look at what you've been given. Walter, no. Walter, look at what we said. Which method are we going to apply? Somebody to try. Walter, we're going to apply the net profit method because we've been provided with accounting from profit. So compute the taxable profit or loss for Zuri. So we say that Ocean and Zuri Limited. I want to have a good space so that every entry should be seen. I can wrap this and we have it on top. We have it here on top. So we can start from somewhere here, Zuri, Ocean, and Ocean Limited, and what we call it Zuri Limited. So we have what we call the taxable profit, or what we call loss. We say as at what we call the 31st, 12, 2025. So when you talk about ocean, what is ocean? Ocean upper, ocean ear, ocean limited, and then we have the Zuri limited. Zuri limited. So ocean is a combination of what? It's a bit blurred. Sorry. Let me check with my phone. Who is experiencing the same thing? T, are you experiencing the same thing? Okay, let me check. Probably internet, but let me check. Let me check also as I join that group so that I see what happens. Let's see what happens. We don't want anything to go wrong. We don't want to see. Let me try. Let me try. We don't want to miss what you do. So let me try with the, I hope it's getting better. I don't know why that should happen now. So we have the accounting profit provided. Accounting profit provided. Are you seeing that? Is it better? No. Is it getting better? No. Check. Let me see as we accounting profit provided. Still not yet. Let me just check. Just a minute to check on something. A minute to check on something. Now looks better. Together. Okay. Sorry. Thank you, Sheila. Thank you. Thank you, Sheila. So what is accounting profit? Accounting profit that is provided. Accounting profit that is provided. Accounting profits provided. For ocean, you add the head office. The head office. You add the head office and the branch. Add for me the head office and the branch. Accounting profit at the end. Add for me that head office and the branch. 6,146,400. Then you add to 21,580,000. Add those two. Remember, when you say ocean, that is head office and the branch. So add the two kindly. So that is accounting profit provided for the ocean. Kindly, that should be 27. 27. I hope the pen is clear. 27. Kater, I'm very keen on that. I hope the pen is clear. 27. They're not small. 7. 26. 76. 400. Zuri branch is just one. Zuri is treated. What is accounting profit provided? Zuri is 47, 47, 594, 594, 594,000. Then you say add back in an exam. Please don't attempt to do what I'm doing. Just say add back. In an exam, for you, just say add back. What are we adding back? Non-allowable, non-allowable expenses. We say in P&L, and what we call taxable. What we call taxable income, not in P&L, not in P and L. And those who have been in class, for class purpose, I write this. However, in an exam, don't waste your time because we don't mark answers, but we mark entries together. We don't mark answers, but entries. Sheila, make sure you don't do that in an exam. Just say add back. What are the non-allowable expenses in the P&L? Let's look back there. Non-allowable. The first one was depreciation. So depreciation. Add for the two, ocean. No, you'll be taking a lot of time. Just say add back, then non-allowable. No examiner is going to look for this. It's just looking for what are you adding back? Add for the two. So don't waste your time for that. So depreciation, add the two, 93.45 plus 58.90. Give me that. That should be 15 to 30. And I hope you know why we're adding, because head office and branch is treated as one, as ocean. So then the other one, Zuri. What is Zuri? So that I don't write my own things. That should be 11. Is it 11,890? 11,890. Is that okay, what I've written down? So then another non-allowable, we have what we call computer software. We have the computer software. Computer software kuna gani peke yake? We only have 4. Zuri, that is 460. There's not entry there. Together, 460 only for ocean. Then you have the next. Lorry scrapped. We have lorry scrapped. So the lorry scrapped again, we also have only for ocean. Then we have what's called loss on investment. Loss on what we call investment. So add for me the two. Loss on investment. That should be 640 on this. If there's something wrong, you let Polimo know as he writes. Then you have 890. Together. Are we together? Hope we are together. So then we move to the next. Intangible assets written off. Intangible, non-allowable, intangible assets written off. Add the two, head office and branch, intangible assets written off. Add the head office and the branch. So 54 for 10. What about the Zuri? Zuri, is it 19? That's okay. Then we have, so there we don't have any. We have 100 years lease. 100 years lease. So we had 30% of that was, so rent, this was okay. So 100 years lease. 100 years lease. What was it for 100 years lease? For the legal fee. What did you get for the legal, for the head office was 100, that was 168. For this was, that should have been 90. Tuko pamoja na 90. Together. Who is not understanding anything? Nani atufuati? Are we all together? Tuko pamoja. We give a yes if you're together. And if you're lost, you tell mwalimu. So then we have what to call. We have now what to call salaries for Zuri. Salaries for Zuri. Head of this paid a staff salary, salaries for Zuri. So the salaries that were made for inventory losses is okay, is allowable. Sorry. Compensation is what you're going to add. Inventory loss is allowable. So salary paid for Zuri, that's non-allowable. You're going to add it back. 9,655,000 together. Are we together on the salary that was paid? Because that's not salary for Ocean Limited. Together. Then we have a taxable income not included. Compensation, we call it the compensation. Compensation from insurance for the loss of stock. And taxable income not in P&L. So compensation from insurance for loss of stock, we know not included, included. What was the figure? The 40% was which figure? How much was it? How much was it? The 268. 268. Is there anything that we needed to add and we've not added? There's nothing that we have failed to add. Together, team, we respond with a yes. And I told you something, that you can miss a number of entries, but you still have everything. You can miss a number of entries, but you still have all the marks. So then we move to the less. So we just put ocean. Then you have the Zuri. What are we lessing? Less what you call? In exam, just say less. Allowable expenses. Expenses not in P&L. Allowable expenses not in P&L. We have the non-taxable income in P&L. And then we have what's called the investment income in P&L. Together. Are we together on that? For exam, that's allowable expense not included in the P&L. Walter, are we together? I hope we're together. So for example, just say less. Don't write all those stuff. That would be a waste of time. So we start with the investment income. So we have the first one, profit from sale of marketable security. Profit from sale of marketable security. Together, profit from the sale of marketable security. Together, I'll be together. That was, we don't profit from the sale of marketable security. We only have it for this. That is 3.8. So we less that. This, we don't less. Together. So then we also have dividends from Wezesha. This is the dividends. Wezesha Cooperative. Remember when I was telling you less them, however, we are going to add it back, but you less it. Dividends from Wezesha Cooperative. Add the two. That should be not that we don't even add, that should be 8. Remember it's net 800. Then for we have for this, that should be 640. Are you understanding that concept that I'm putting there? We're saying these are investment income. However, tutazziongeza, the ones that are non-qualifying, we're going to add them together. Then you have interest, that is interest from what you call from bank. Interest from bank, that's an investment. So for Ocean, you add the two, that should be 550. Ocean, that should be 550. Ocean should be 550. Then this should be 160. Together. Are we together? We respond with yes if you're together. Are we together? We respond T, tuko pamoja. Asante Sheila. So then we move to the next, we have the investment allowances. Investment. What is the investment allowances on that? What do we have? We have the software, computer software. So we have the computer software. What is the rate for the software? That should be 25% times 460. So what is that? For the software, Ngapi? For the software. Give me that. We have to finish this question. We have to finish this question. So that is 115. Now just for 115. 115. Then salaries for staff. Allowable expenses that was not included. Salaries, we say for staff. This one that we added back, so for this we less it. So this salaries for staff was allowable expense that was not included. So that is 9655. 65. We less that. Salaries. Is there any item that we need to less that we've not less? Is there any item that we need to less that we have not less? Somebody? Is there any item that we need to less that we've not less? Somebody, have I skipped anything? Not really. Not really. So then we get the taxable income for taxable income, taxable profit or loss. This is for the business. So get for me for Ocean, kindly for Ocean. Get for me that. Let me just see camera. So this. So get for me for Ocean. This is for business. We are going to add back other incomes, but get me for that. No, that's allowable. That's allowable expense. We said, Hassan Mohammed, the 670 is allowable. Are we together? When you have the loss of stock, are we together? That's allowable. So our inventory loss is allowable. Together. And when you get compensation for that loss, we now tax. Hassan Mohammed, together. Inventory loss is allowable expense. And when you get compensation for that loss, it now becomes a taxable income. Hassan Mohammed, are you together with Mwalimu? Walter tuko pamoja on that explanation. Hassan, are we together on that explanation? Then Celestine, the guys that I need to mention everybody. Everybody, I need to mention everybody. T has been Sharon Chengo, tuko pamoja. Hassan, do you get me? That is under investment allowance. That's a capital expenditure. Computer software is a capital expenditure. So we claim investment allowance. We claim investment allowance. Can go together. So, which is which? Up and up. I'm not big on answers because I told you these answers are constituteless. I'm not big. How much is this? What is this figure? Is it 1 or 3? This you say is 1. Celestine, hold it there. Yes, FJ and Celestine. Let me just have this. First of all, then I get back to you people. 103, 97. You have the 97, 400. What about this? Then I get back to Celestine and Chengo. This other one is how much? 69075. You get the 69075. 69075. So Celestine and Chengo, you just give me a yes if I'm responding to your issue, just to know that you are there. Hassan, you did not respond to me. Hassan? Celestine, are you sorted? Hassan, you did not respond to me. Hassan, are we together? Then Celestine and Chengo. The head office branch staff salary consists of 9,655,000 on behalf of Zuri. You see, Zuri and head office, Zuri and Ocean are independent. Are we together? You're good. Perfect. Chengo, Zuri and Ocean are independent. So if they pay for Zuri, which is independent, we tax them separately. That becomes what we call non-allowable expense. Are we together? Chengo, that becomes non-allowable expense. However, we know that if they paid, we add it back because it's non-allowable. When you get to Zuri, we treat that staff salary as allowable expenses that was not included. So therefore, we're less. Sawa. Understood. Then we add back, add what you call add other incomes. Other incomes. So say dividends from Wezesha, we call it Wezesha Cooperative. Dividends from Wezesha Cooperative. Somebody says 965. Sorry, you're the ones who give me these answers. I'm not very much interested in the answer a lot, but you calculate and give me. So we say that these incomes are subjected to further taxation. So we come here, we subject them at gross. When you're subjecting an investment income, you subject at gross together. When you're subjecting an investment income, we subject them at gross. So we can use, I will take time. Let me just use that. Sheila told me that, but I will settle down and get the right answers. Is that okay, Walter? You realize that most of the things that I teach you here, I will get for you the right answers. Are we together? I will provide that. But you can check by yourself. I was not calculating, but I can calculate. So then dividend from Wezesha, when you're subjecting to further taxation, we subject at gross. Together, team, we subject at what? At gross. Together. So that is 100, that was 85. Then you say times. For head office ilikuwa ni ngapi? Head office ilikuwa ni 800. Ingine ilikuwa ni 640. Give me the gross figures, tafadhali. Give me the gross figure. 100 over 85 times 800. When you're subjecting to further taxation, what do we have? 100 over 85 times 800,000. So this is 941, 176. You don't need to all numbers. Then the other one, we get 100 over 85 times 640. So this is 752, 941 together. Are you getting the same figure? Then you have interest. We have it from bank. We get the gross. Remember those figures were net. We respond kindly. So those figures were net. So when you're subjected to further taxation, we subject it to gross. Asante, tuko pamoja. Sheila. Walter, you forgot to add? Yes, where Lawson? See, it's here. They're here. Sheila. Look up, Sheila. Lawson, eh? Look up, Sheila, you sing. Respond, Sheila. See, I added them back. Lawson investments, 640, 890. Walter forgot. That's okay, Walter. So interest on bank, interest on those banks, they were also net. So we have 100 over 85. Then we have the total for the bank, we have 550. Now 550. This other one for Zuri took on 160. Get for me the gross figure. Get for me the gross figure. So 100 over 85 times 550. So this is 647, 647, 059, 059, 59. Together. Kindly help me confirm so that you must also confirm times 160. So this is 188 to 35. Confirm those. Confirm that. Then we have the interest from loan. That they sent interest from loan, 10% interest from loan. So the 10% was 10% times 5 million. That was an income for Zuri. So Zuri, we have 500. So down here we have what's called the total taxable income. So get for me the total taxable income. Are we together? Kama tuko pamoja tubonyeze yes. Hey, we respond kindly. We respond with a yes if you're together. Perfect. So get for me total taxable income. Ongeza hizi to that. Get for me the total taxable income. Please get for me Chengo. And you're my people. We cannot do anything minus so that I get to another class. I'll only do this part 1. Part 2, when we meet on Tuesday to chambue your part 2. Tuko sawa? Because it can take long. So we finish this very fast, then I just give a direction. Total taxable income. What is the figure? How much is here? Somebody to help me so that I can get to another class. Somebody to help me. Just add for me this 2. And you add for me this to this. Kindly. 105, 5, 105, 515, 635. Then this other one is, get for me that. Very fast. The other one, kindly, very fast. That other one. That other one. I'm getting to another class. So we have 71, 406, 46, 176. How many marks was this particular question? How many marks was this? How many marks? 12. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 1, 2, 3, 4, 5. So those are 25 inches. So say 25 inches, we'll just say any 24 times a half, that will give you 12. Sawa. Any 24 times half, that should give us 12. Together, that's how we respond to that. So God bless you, and God bless our class. Together. Yes, so we can close that. Is there somebody else, something that is burning? So we close it there. God bless everyone. We meet. Okay. Thank you. Thank you. I hope you've enjoyed the class. And please support Focus. Kindly, something that I have failed to support Focus. Kindly support Focus. We beg you, kindly support. We cannot do anything without you. Kindly support us. I know you people have friends. Tell them about Focus. If you enjoy what you're doing here, you tell them. Senor Kennedy, is it true? Robert, is it true? Asan, is it true? Support Focus. Focus is the best place to be.